Our market monitor tonight says we are in, quote, a rip-roaring bull market, despite the geopolitical concerns about Ukraine and Russia. He's Marty Leclerc. He's Chief Investment Officer at Barrack Yard Advisors. Marty, welcome. Let's make our audience some money tonight, shall we?
Always up for that.
All right, let's start with your first pick, which is Carlyle Group. Why?
Carlyle is a big global asset management firm. They manage something like $200 billion for some of the biggest pools of capital on the planet, sovereign wealth funds and big pension plans. But they're an alternative asset management firm. And we like Carlyle because pure valuations, and we think it's a growth vehicle. They are the best-in-class operator. Carlyle earns money three ways. They get an asset management fee, just like a Templeton or some of the other firms that your viewers might be familiar with. But they also get what's called an incentive fee. It's called carry, where they get to share in the underlying profits of the investments. And then thirdly, what they do is they own some of the investments underlying the portfolio as well. So that's another way they can earn money. Carlyle's trading at around 10 times earnings. The dividend yield is 2%. However, every year, that carry that I mentioned is paid out to shareholders. And last year, it worked out so that as a shareholder at current prices, your dividend yield was like 5.75%. Now, that's not, that's going to fluctuate and that's going to be lumpy, but we think that's very attractive. Finally, it's a 30% discount to its book value of 47.
Okay, all that sounds good. Let's talk about your next one, Aqua America. This is a water firm. WTR is the ticker symbol, which makes a lot of sense. Why should someone buy this at $24.39?
And it also kind of looks expensive because it's trading at 20 times earnings. However, it's averaged higher PE than that over the last 15 years every year. The dividend yield's 2 3/4. Well, we like Aqua because it's what we would call a predictable growth story. They have their organic business, which is supplying water to consumers in Pennsylvania and other areas. However, the great opportunity is that 85% of the water systems in this country are municipally owned. And the opportunity here, and what they've been taking advantage of for a couple decades, is buying these water systems from municipalities who are starved for cash, buying them really cheaply, and then investing in these systems, making them world-class, and getting a regulated return that's quite attractive. So we think they can grow 8 to 10% both their dividend and their earnings.
Let's move to your third choice, which is a little company not many people would have heard of, Marty.
Yeah, IBM is much maligned. It's perceived as a no-growth story, notwithstanding the fact that their earnings have compounded by 13% over the past 5 years and 14% over the last 10 years. They're selling cheap, 10 times earning, 9% free cash flow yield, which gives them a lot of money to be able to reinvest in their business, but also to pay out a dividend and buy back more stock to continue to shrink the share count. What IBM's not given credit for is that it's one of the most innovative companies on the planet. Over the past couple of decades, every year they're either number 1 or number 2 in terms of the number of patents awarded to them by the U.S. Patent Office. So we love IBM for
let's get
being
to
a cheap
disclosures.
value stock.
Do you or your family members own any of these companies personally or in funds?
I own all 3 of them personally, as do my clients and family members.
Thank you very much, Marty. Appreciate you being with us. Have a great weekend. Marty
My
Leclerc
pleasure.
At Barrack Yard Advisors.